which gave some clarity on the economy, might cloud the Fed's rate cut plans. Maybe not. Let's bring in former CEA chair and professor at Harvard Kennedy School, Jason Furman, and Jefferies chief market strategist and CNBC contributor, David Zervos. Gentlemen, happy Friday. Jason, so 50 basis point single cut, pretty much off the table now, you're saying. Is there any big worry now?
Look, I'm not even sure why 50 basis points was on the table, but maybe we know now. It's so if you get a report like this, you can sacrifice it and keep going ahead with 25, which looks like what they're doing. We obviously have an inflation report. That'll be the one other big thing. But I do think their primary motivation for cutting rates was concern about the employment side of the mandate. And you just have to be a lot less concerned now than you were 2 months ago.
So, David, when the Fed just put the focus on labor as being more of a concern going forward versus what the balance was before, and then you get kind of a blowout jobs report like this, what do we need to see? Well, what do investors need to see on the inflation side to feel confident that these levels that we've reached on the Dow, we're near record highs on the S&P as well, above 5,700, that they could hold and maybe even continue to climb higher?
I don't know if there's much on the inflation side that's really going to get in the way of stocks. I think the focus did go to the employment side. And really what Jay did at the last meeting was kind of hedge himself nicely for a weak report. He got ahead of it. He did the 50. But remember, John, in the guidance, he was very positive. He gave us really rosy guidance. He said, things look good. I'm doing this kind of as a bit of a hedge. And want to recalibrate, that was the word. But he certainly didn't commit to doing a fast set of moves. In fact, he said, quote, he was in no rush. So I think Jay really got his dovish cake with the 50, and he got to eat it too. And that's what he's doing today, is he can kind of look to the market and say, hey, guys, I never told you I was going to go fast. I just wanted to get 50 in, see how it's going, and make sure that if we got a weak number, I was not behind the curve. And he's clearly not behind the curve. He's in a good spot. And I think the market's not going to question that 50. We're going to look back on it and think that was good risk management. We get a couple of 25s into the end of the year, unless the employment numbers get revised and go down a lot in the next report, and there's something to talk about at the December meeting. But, I think we're on a decent trajectory, and the equity markets look very strong if we get another 225s going into the end of the year. Okay. And a lot more will depend on the election, John.
Yeah, we still have a lot to watch here, to your point. Jason, wage growth, it was stronger than expected. It's been pretty resilient here. It raises the question, why? And just as importantly, perhaps, can that continue without reigniting inflation or perhaps keeping inflation stuck where it is above that 2% target?
Yeah, if you look at wage growth, it was in September slower than I think any of the last 5 or so months. It's still running at an annual rate of about 4%. That's what you think you'd have in a world of roughly 3% inflation. So if there is a risk of inflation to the upside, I think it is that the labor market is maybe telling us some signal that we're missing in all the noise on the price side. More likely, though, you're going to continue to see wages slow. Some of this is catching up for the earlier real wage losses that workers had. And maybe, just maybe, we have a little bit of faster productivity that would justify and support that faster pace of nominal wage growth.
David, the fact that you saw yields move higher in addition to equities today, what is the bond market telling us about the data we're getting?
I think the bond market has really got back into its usual place, which is as a hedge to the risk-off world. And when stocks go down, bonds are going up, and vice versa. So I think it's really back to our lovely world of risk parity, and it's been a wonderful year for that. So I'm going to cheerlead that a little, as I usually do with you, Morgan. But I will chime in on the inflation side. It's really hard to be worried about inflation because things are a little perky on the growth side after we just had 8 quarters plus of growth above potential by any measure, while inflation has come down from 9.1% to 2.5%. We've seen a real outperformance on the growth side since the middle of 2022. Super strong growth. I don't think we've had a single quarter except for one barely below 2% lots of 2s, 3s, 4s. I think we even had a 5 in there on a quarter, and inflation just kept coming down. So the idea that, we have an inflation problem just strikes me as a little bit of a silly one. I think we're going to work through it. We've got some housing-specific inflation that has to work through the system, but the Fed should feel very comfortable with how things have progressed over the last couple of years. I mean, it's been incredible, to be honest with you.
Yeah. We'll continue to watch it. David Zervos and Jason Furman, thanks for bringing us your insights today.